Good morning, good afternoon, everyone. My name is Stuart Brodsky, and I'm a clinical assistant professor at the Schack Institute of Real Estate at NYU. And I'm very happy to be joined here by Brenna Walraven of Corporate Sustainability Strategies and Dave DeVos of LaSalle Investment Management. And we're going to talk today about ESG, environmental social governance. The topic of ESG is becoming increasingly hot, becoming increasingly central to conversations about how organizations, companies behave and communicate their practices to their stakeholders, both their investors as well as their customers and clients. ESG stands for environmental, social, and governance, and the field of inquiry around ESG is what are the metrics, what are the characteristics, and what are the reporting mechanisms associated with ESG that the real estate industry is engaged in, whether they are being pushed or whether they are being pulled, and how is the conversation about ESG and the request for metrics advancing the issues that are the subject of the metrics. So let's start by asking Dave DeVos of LaSalle Investment Partners to provide a little bit of insight into, well, who you are, who is LaSalle Investment Management, who are your clients, and what is it that you do that responds to their inquiry on ESG?
Well, Stuart, thanks very much for having me, and welcome everyone. LaSalle Investment Management is a large $70 billion global investment manager with a sole focus on real estate. For your information, we are a subsidiary of Jones Lang LaSalle, also known as JLL, and we have equity, debt, and security investments. And today we'll most likely focus on the equity investment piece. And our products range from the risk spectrum from core to value add. Our typical clients include institutional investors, which would be pension funds, foundations, endowments, also some high net worth individuals. It's a global client base, so those global clients bring in global issues to us. And among those global issues, certainly ESG is an important part of the conversation, increasingly more so over the last few years. I think what investors are asking for is they're asking for their investments to reflect not only their financial objectives, but also their values. And since we function as a fiduciary and we work on behalf of our investors, we do try to meet their needs and certainly listen to their concerns and issues. Hopefully that's a good start.
Sure, that's very good insight. Just one last question before in this context before I shift over to Brenna is when you say LaSalle Investment Management is a 70 or 80 billion dollar. Did you say 70 or 80 billion dollar assets
Right.
under management? Is that make it one of the largest? Do you have a lot of peers?
It's among the largest at 70 billion. I think I know there's some larger firms out there, but certainly in the top 15 or 20. I might add, I've only been with LaSalle since the first of the year. So some of my knowledge and depth of knowledge isn't quite where I'd like it to be as of yet, but we'll get there soon enough.
But you're not the only ones who are involved in this conversation. Your peers are also involved in the ESG, and you have.
Sure. Absolutely, and I think that could be represented perhaps by the number of participants in the Global Real Estate Sustainability Benchmark Survey, which I think last year totaled over 1,300 investment funds. So there are a lot of us in this space and a lot of us working diligently to move their firms and their products forward.
Right. That's interesting. So Brenna has been, I've known both of you for quite some time now, but I've known Brenna from days where the focus of the conversation was on environmental issues, and specifically early on in my engagement with Brenna was on energy efficiency. Brenna, can you tell me a little bit about your firm and how you've gotten to this conversation that is ESG as compared to just the E?
Sure. So Corporate Sustainability Strategies is a consulting firm focused in the topics that we're going to be discussing today. My clients represent about 150 billion in assets under management. So pretty diverse, both US and global based, and also include, similar to Dave, my clients, not only direct investment in real estate, but also investment in real estate debt, real estate equities. So kind of across the capital stack, making investments. And through my background and having almost 30 years in real estate operations, and kind of understanding the value proposition of it makes sense intuitively if we get more efficient and we reduce waste, that's a good thing, not only for the environment, but financially, right? And so to your fundamental question, how did that kind of evolve to ESG topics? It's just been a natural progression, I think. There is an interlinking between these issues on many levels, right? Good governance is not just an ESG thing, it's a good business thing to make sure that you have not only good policies and codes of ethics and anti-bribery and fraud type provisions, but also to have a monitoring process and a training process, which then starts getting into social, all of which can lead to better financial outcomes and less risk. Well, they're all start to be about lower risk for investors, and how we manage not only the risks, but also leverage the opportunities across whatever the real estate investment platform. I think that probably speaks to that, but certainly looking forward to our discussion today.
Great, yeah. So these investors who are tapping real estate industry to demonstrate and discuss their ESG, are they doing the same in other investment sectors, or are they doing this just in real estate? Is this just something that real estate is involved with?
Well, I'll start, and I'm sure David has some perspective, both now at LaSalle, but even with his career with PGIM, Prudential's investment arm. But it is definitely first and foremost focused in real estate, but this is true for every type of company. And we're seeing this more and more. So you see the advertisements from Amazon, McDonald's. I mean, they're all kind of putting their stake in the ground. But coming back to the real estate investable capital stack, I mean, I have clients on their real estate debt investments who are saying, how do we integrate ESG elements? And that's everything from borrower questionnaires, the things that they're tracking on the portfolio, climate risk assessments on their debt portfolio. So I think it is bleeding to every means and method within real estate investment, certainly for real estate, but more broadly for corporations and every types of investment vehicles. Curious in David's perspective.
Yeah, if I can add on to that, the principles for responsible investment has been around for a long time. Many large institutional investors are signatories, including LaSalle, as an investment manager member or signatory. So these issues are broadly based across all investment sectors. I think that there's been an opportunity to have a focus initially on real estate with the E, because the E is, I think, a little bit more tangible than you might find in other investment vehicles. And so I think there was a natural starting point on the E with real estate. Relative to the G, I've always considered the G to be table stakes across any investment. I mean, you need a solid governance program just to raise capital. So without a solid G, you're going to have a very difficult time raising capital. And I think the S, the social issues, certainly have come to light, certainly with COVID and health and well-being. Some of the social issues here in the United States and elsewhere, bringing light to, not just where are we investing, but how are we investing? And I think the how has become increasingly important to investors, or particularly over the last few years.
Okay. So these investors are asking these questions, as Brenna raised the term, in order to understand and manage their risk. Can you talk about that a little bit more? And also, is there a flip side to the strategy of I guess, investing defensively by understanding risk? Is there an upside that is understood or presumed to exist for working with companies, through investing with companies that are outstanding in demonstration of ESG?
Well,
Sure. Yeah,
go ahead, David. You go first. So please.
Okay. I was just going to say just take climate change as a potential risk, right? So there, you've got the physical risk and transition risks. The physical risks, I think, are again fairly understandable: flooding, hurricanes, sea level rise, heat stress, water stress, wildfire. Those are the common physical risk factors that certainly play into the valuation of real estate and the risk exposure to real estate. But then there's also the transition risks, which would include things like regulation, reporting, insurance premiums and coverage, building codes, carbon pricing, reputation, technology. All of those kinds of issues change with time and change relative to your exposure to climate. So, you know, there, just as there is a perhaps a green premium, there's also a brown discount. And I think investors are really trying to understand how that comes into play with their own investments.
1000% agree. And of course, well said. I think I would just build on this as another signal and indicator about this was the CEO of BlackRock, Larry Fink's, annual letter to CEOs, where he firmly stated, climate risk is investment risk, right? And so that's the biggest kind of elephant in the room, is how are people managing, again, these risks, to your point and your question. And that can be an opportunity if you are able to successfully navigate that and mitigate those risks and be able to report and transparently demonstrate how you're managing the risk and leveraging the opportunities. You have, not only a better chance of higher risk adjusted returns, but also a chance to be a leader and get a disproportionate share of capital, et cetera, et cetera. So they all flow together. And I think when you hear folks like Larry Fink and his letter, you just have to keep in mind that BlackRock represents about $8 trillion of global investment capital. So it's a meaningful implication, and they're not the only one, right? Nuveen has announced a global impact strategy that's focused on issues of income inequality, a social issue, and climate change. MetLife has gone to a net zero program to take several of their funds to net zero, kind of in response to some. So these things are coming up not just from the biggest gorilla, in BlackRock, but more broadly with investors, both in Europe, certainly, but more globally as well.
When you say net zero, can we back up 1 second? You mean what?
There will be a quiz later.
No,
but what we mean by that, in the simplest terms, is the way to think about it is, first, it's understanding what your carbon footprint, and usually that's measured through what's called scope 1, 2, and 3 emissions. Scope 1 emissions are things that where you generate an emission on a property. Let's stay in real estate vernacular here for a moment. So if you had an emergency generator that you had to run once a month to keep it maintained, and in a case of emergency would run, those emissions would be your scope 1. Scope 2 would be those emissions primarily from your use of energy, so electricity, gas, the use of that energy. You'd calculate the emissions for those. And then scope 3 is kind of everything else. So your commuting, your travel, your waste, your tenants' emission. Those are the kind of scopes. So if we understand what our inventory is, what are we going to include all 3? Are we going to typically look at 1 and 2 where you have control? Once you know what your inventory is, how do I reduce those emissions? And that's things like, 1, operating well and getting more efficient, reducing waste, implementing more efficient equipment and systems, either at time of failure or at time of replacement, or even more proactively. But it's also looking at on-site renewables as a way to, again, reduce those emissions. And then once you do those kinds of things, whatever's left, you're generally buying offsets of some sort to reduce those emissions to zero, to a net zero. I think the fundamental comment that I would make is it's more about the zero, not the net. So we can't do business as usual and pollute and use as much emissions as we always have and just write a check and think we're okay. It doesn't get us to where we need to be in terms of reducing risks of climate. It's more about getting more efficient, reducing waste, making investments in technology and renewables as a way to really shove down those emissions as close to zero as we can, and then spend what we need to do to get to zero as we chart our path.
Excellent. Excellent.
And if I could add to that, LaSalle has made a commitment to net zero carbon as well. We've committed to the ULI net zero by 2050 commitment, and also to the Better Building Partnership climate change commitment that's based in Europe and the UK. As a result of that commitment with the Better Building Partnership, we've published our net zero carbon pathway, which demonstrates our process in terms of how we plan on getting there. So that includes, as Brenna mentioned, the energy efficiency issues, and really trying to drive down that carbon produced on site. But the Better Building Partnership also talks about embodied carbon, and that's the carbon that goes into the construction of buildings. So we're also looking at how we build our buildings. And then, of course, the last thing that we would want to do is to actually buy offsets. And so our plan is to reduce our consumption of resources as much as possible, to clean our buildings and reduce our carbon emissions as much as possible. And then ultimately towards the end of meeting that commitment, we would reach out and purchase offsets where we would need to.
Right. Interesting. So the ULI commitment, or that's the Urban Land Institute, which is an industry association, the net zero carbon pathway that you discussed through the Better Buildings Partnership is part of the Department of Energy. So that's a federal partnership, federally supported partnership program, right? That
well, the Better Building Partnership is a UK organization that's different.
Yeah.
Yeah, and they are actually affiliated with Greenprint at the Urban Land Institute.
Okay.
So there's a relationship between the two. What's interesting is there is a distinction in terms of the scope of the ULI commitment and the scope of the Better Building Partnership commitment.
This sounds like there's a lot of different pathways or a lot of different resources and protocols. And this is just on the environmental side. I want to get to the social and the governance side, but
right.
How do you, is that part of your burden is to manage the challenge of understanding which pathways, which protocols to participate in, and how confusing it and how much is that evolving?
It's evolving rapidly. The World Green Building Council has a net zero commitment. There are net zero certifications out there. So to your point, Stuart, trying to navigate the platforms that are out there and choosing the ones that are most suited or best suited for our portfolio. And quite frankly, trying to understand where the market is headed. The ULI commitment, as mentioned, does not include embodied carbon. But many of our European investors are very interested in embodied carbon. As a result of that, we will be paying attention to embodied carbon, whether or not the ULI commitment reflects that. So you almost have to take your lowest common denominator if you're thinking long term, looking at that lowest common denominator. What is the more stringent of those targets and platforms, and start to think about how you're going to address your entire global portfolio to meet those targets and commitments.
That's complicated. I mean, Stuart, to your point, and as Dave's kind of just touched on, is there is no one right way to do this. I do think it has to be an all of above now scenario. Right. And that's what's been amazing to me. Literally in the last 2 years, this has gone from like 0 to 50 in terms of ramping up. So if you were to Google firms that have made a net zero commitment, you would be amazed. Because I just moderated a panel on carbon neutrality with folks like Dave and I know well, Sarah Neff from Kilroy Realty, and Ryan Tinnis from Hudson Pacific Properties on who's have achieved their carbon neutrality objectives. And so it's just amazing to see something that, as I like to say a dog won't hunt. Like nobody was interested in this even 3 years ago, to see such a shift. And I think there's just the realization, and not only from investors, which is certainly there with the Larry Finks and all the things we've been talking about, but the general public is increasingly aware, right? Like if you're in Texas today, you have a very different perspective on the risks of climate and how that being prepared for it and being resilient is a thing. Because every county in the state of Texas a couple of weeks ago, when that kind of cold snap hit for several days, every county went into a state of emergency because of the impacts to power shutdowns, water lines breaking, and just complete havoc. California, right, we're exposed to a lot of wildfires, for example. We've had 5 of our worst fires in the last year, 2 of which were within a span of 60 days. So that's hitting not just some isolated, or as I like to say, climate change is everywhere. In 2017, 1/3 of all US counties declared some form of natural disaster or emergency. So when the general public is aware, then they start saying, hey, I want to know what is happening, what's changing. And so my last comment on that, and I heard it this morning, Morgan Stanley did an analysis and said 1 in 4 of every investment dollar is following sustainable investing. That is a huge signal about where we're going. And that's why these things are starting to happen.
Yes. Okay. And so what about, this is a lot of conversation about the E.
Yeah.
Can we dig in a little bit on and give some equal weight and equal depth of understanding to what the S looks like? And as well as David said, the G is table stakes. What does that mean as well? But what are the components of the S?
Maybe you want to start?
Sure. For me, I would break the S into internal and external. So your employees certainly cover part of the S, and in most firms, your HR team is managing a lot of that. So it's fair pay, it's health insurance, it's annual reviews, those kinds of issues that come into play. Health and well-being, I think, with your employees comes into play there. Externally, I think it gets to the development process, so the supply chain within the development process. Again, safety issues maybe play a larger role there. And then certainly your building occupiers, both your property management teams and your tenants, and their health and well-being, I think comes into play. And then also how we address social issues within communities where we've got assets. So, for me, it's the internal and the external. My focus is more on the external and what's happening at the properties than internal, but there are plenty of opportunities to address that just with how we manage our properties. But then I also think it comes into considering topics like affordable housing and how are we addressing that? How are we accelerating affordable housing? That isn't just a U.S. issue, that's a global issue. Mm-hmm. So there are many other factors. We had in my previous role, we had industrial assets in Mexico. And one of the biggest issues we had there was how do we get workers to and from work safely? So the social issues are out there. They vary by region. There's a common platform, I think, globally, but certainly there are regional variations as well. Brenna?
Yeah, I would echo everything that Dave said. I think that the other thing that I would add is the way I like to think about social issues is really it's around engagement fundamentally. And that is not just things like surveys, but it's having conversations and then taking that information and trying to implement, best practices or change in a way that supports health and wellness, that supports, better outcomes, that supports more transparency, whatever the issues that are identified. And I think that's ultimately what investors want to see. Employees certainly want to see more engagement, more two-way dialogue, as opposed to you will do this and this is the rules. It's, let me tell you what, I've got 2 kids that are under the age of 5 and I'm trying to work. So can we have a conversation of what that might look like? The other thing that I'll layer on to this is that, we've really gone through a national reckoning on the issue of race in the last year that I think feels different. And we've had something like north of 4,000 different protests and demonstrations in the last year. These things are a signal that things are changing. And I know certainly in the investment world, one of the big ones is, equal pay for equal work. But I think you're going to see more in that, which is an overlap between governance and social. And then I think companies are listening and they're making statements and commitments. And in fact, LaSalle, and I'd be interested in, Dave, you may not know a lot being new to the company, but has a scholarship program for Black and Latino minorities, and, towards their education, which is great. I think New York Life has a program called Candrium Academy. I had some notes. I wanted to make sure an accredited and innovative training platform to provide essential education for financial advisors and intermediaries on sustainable investing. So it's about sustainable investing, but it's about providing training and understanding and education. That's a social bucket, governance bucket. And so to see how these start being interconnected.
Well, and I'd like to add to that, and that is, our investors are asking a lot of questions about our own internal diversity metrics. A lot of investors, and I think there are studies out there that suggest that more diversified organizations tend to have slightly better profitability, tend to have slightly lower risk. And so there is a desire for knowledge from the investors in terms of understanding where do we sit with diversity, equity, and inclusion? How are we addressing issues where we may be falling short? Where do we sit relative to our industry peers? All of those topics are coming up in RFPs, and the RFPs, just like the interest in ESG, the RFPs with ESG issues have accelerated dramatically. I am spending an increasingly larger and larger percentage of my time responding to RFPs to address investor questions on environmental, social, and governance issues.
Is progress in ESG integrally or inherently related to each other? And is that why you're in the middle of the conversation, or is it because you're just shown yourself through your work first in the environmental arena to be the most adept at managing how to integrate new areas of inquiry into your pro forma?
I think how I would answer that is integrating ESG across your business processes adds value, and the better integrated firms are probably more streamlined in their reporting and therefore more profitable, or having a lower cost to disclose and to be transparent with their performance. I mentioned earlier how ESG can influence attracting and retaining talent. How does ESG also help in attracting and retaining tenants and investors? So across the stakeholder field, everyone's got an interest in ESG at some level, and trying to address those issues comprehensively and programmatically and integrated into your processes, I think tends to add value and mitigate risk across the board.
Great.
Is leadership in ESG garnering more investment or attracting more investment dollars, or is it simply a matter of participation in ESG in order to not be excluded from investors who want you to be managing per their priorities and their values?
I'll start and say it's both of those things. There's just no question about it. I remember early days when I was back at USAA Real Estate and this has been 12 years ago, something like that. So not too long, but definitely a while ago. And we were asked to participate in the then first GRES survey by an co-investment partner from Europe. And we ended up being ranked #2 in the US. Suddenly I was very popular because it was like, oh, we're doing some stuff. Oh, we got a good story. Hey, we got ranked well. That enabled us not only to obviously keep that investor who knew we were doing these things, it just reinforced their belief and understanding of what we're doing. But we got another $200 million of co-investment capital because they saw us as a leader, not just as okay or good. But I think the counter side of that is I have clients today, they're publicly held, that because BlackRock, for example, is one of their investors, and BlackRock has said you are uninvestable if you're not taking steps and being transparent. So I think it cuts both ways. It gives you an opportunity to be at the table with more and a broader, diverse range of investors, but it also keeps you from being off the list. And I think you don't often know you're off the list. I was having a discussion with Townsend and looking at an analysis that they do to evaluate investment managers that they work with. And Townsend is the largest pension advisor in the US today. And I saw a client of mine, a new client of mine, on the not rated, could have been off the list. Now, fortunately, this client has made huge gains and is doing all the right things and understands that, but they had no idea that they were going to be off the list. And that's the thing I think they're starting to realize. And that comes back to that $1 in 4 dollar, one of every $4 invested is following a sustainable investment. And so they're saying, I've got to have a story and do that. And I can't just, make something up or greenwash. I actually have to show some policy, process, program, and results. And that's, I think, a big signal in all this.
Yes. And for me, I had a call yesterday with a European investor, very specifically asking about ESG questions. They're a large investor of ours. And they've got a very keen interest in what we're doing and how we're doing it. And it was a very detailed discussion. We were talking about our ESG policy and the strengths and weaknesses of that policy and how they'd like to see that policy evolve because they want their investment managers' interests to align with their own. And it's just really interesting that they're looking for like-minded investment managers that are considering ESG risks and opportunities in a similar fashion.
Okay. Does the source country, the government commitment at the source of the capital, whether it's a sovereign wealth fund or a public employee retirement system of a foreign government, and their commitment to the Paris Accords, drive this conversation at all?
Sure. I'll go ahead and start. Absolutely. In fact, in Europe, they've just, not just, but they have recently announced the Sustainable Finance Disclosure Regulation, where investment funds that are headquartered in Europe or investment funds that are being marketed to European investors need to comply with the SFDRs. Part of that is declaring what kind of product you are, and it's an Article 6, Article 8, or Article 9 product, which essentially say you're thinking about being green, you are green, or you've got basically Article 9 would be the greenest of products, where you have an investment thesis that's focused on either an environmental or social theme. So there's clearly a regulatory drive here to A, prevent greenwashing, and B, push the market further.
Okay, interesting. And in the United States, we've have a new administration that is saying we're going to be back in the Paris Accords, and that it's important to the administration to look at sustainability issues. How is that changing our conversations?
I mean, I'll start to say, first and foremost, even though we were out of the Paris Accord, I mean, technically not that long, but the signals and from a regulatory front in the last administration were certainly not positive to issues of the environment. But states, counties, cities never stopped the charge, right? They kept moving forward. And that's why you have, 3 states, 2 counties, over 30 cities have energy benchmark and disclosure requirements. You have cities like San Francisco going to 100% renewable by 2025. New York has the local law 97, which puts a cap on carbon. So these actions have kind of been happening in the absence of regulatory or legislative policy at a federal level. That being said, I think the administration has been crystal clear that facing climate change is one of their 4 pillars of their policy objectives. So first and foremost, not only joining the Paris Accord, as you touch on, Stuart, but also focusing on what can they do at a regulatory front to kind of turn the tide and reduce pollution, waste, and things of that nature. And I think that's a huge signal to the market. I mean, if you look at the car industry as an example, they too did not stop working on fuel efficiency. GM has just announced they'll have over 30 vehicles that are electric by 2025. By 2035, their entire fleet, GM. We're not talking. These are trucks. These are big cars that they are saying, hey, we didn't lose one step, regardless of what's happening at a federal level. I think the other thing is that financing mechanisms will be a big focus of the administration, and looking at public-private partnerships to finance deeper investments. Certainly something that I have advocated for years is real estate owners being able to get the financial value of CO2 emissions, i.e. utilities can incentivize real estate owners and operators to invest in deeper retrofits by giving them upfront incentives to make those incentives. So not just incentivizing lighting retrofits, for example, but chillers, HVAC equipment, windows, like big stuff that really gets to fundamental emissions. That's where I see some of this, financing mechanism, and that's I'm being told is something that the administration is going to focus on.
Sure, and certainly the extension of the investment tax credit for renewables certainly plays into that. So we've got more time with a larger credit still in hand. It didn't sunset, at least not yet. So there's another opportunity there. And I'd like to go back to investors. Just because the administration changed, investors didn't. They still had an interest in it. And in fact, it felt to me anecdotally that European investors had a stronger level of interest in ESG when the administration changed 4 years ago. They wanted to make sure that they weren't being left out.
Right. Interesting. So both of you have mentioned, I think both of you mentioned GRES. Can we talk a little bit about where GRES comes from? What is it? And are there other mechanisms in it that are in the same market area?
Well, like Brenna, I've reported to GRES since the very beginning, and it has evolved. It started out, and it evolved out of the academic arm of the Principles for Responsible Investment. Niels Koch, I think, was the founder, one of the co-founders of that organization, and it certainly has evolved with the market. It initially focused on policies and best practices, and trying to capture environmental metrics. Then it grew stronger in the environmental metrics, and now it's gone again. It's migrated to include things like resiliency, renewables, and social equity. So GRES has evolved with the market, I think, relatively well. It seems to be the de facto standard for real estate investment funds globally. And getting 1,300 participants in 2020, I think, is indicative of their growth and its presence in the market.
Yeah,
Brenna?
I'll just build on that. First, I just think it's helpful to understand what GRES is. So GRES used to go by the acronym, now they just go by GRES, but it's the Global Real Estate Sustainability Benchmark. And what it is a relative benchmark of ESG elements across policy, programs, process, and performance. And it's based on comparing your performance against peers. So if you're privately held US-based office portfolio, you're going to be compared against those types of portfolios. If you're diversified is where it gets more complicated, if you're public versus private. So that's what GRES is. And to Dave's point, I guess that my big add to that would be the fundamental scoring has really shifted to be 70% now around performance. So don't just tell me you have a policy or a program. That's great. That's 30%. Tell me what your performance is in actual data. So what's your energy consumption, water consumption, waste consumption, or metrics? What is your greenhouse gas? And then how much have you reduced or improved? How much renewable energy do you have and deployed? All of those building certifications that, reinforce efficiency and or sustainability, health and wellness elements. That is the Alexa cancel, sorry. That is 70% of your scoring today. So they are fundamentally focused on not only providing transparency and a relative benchmark specific to real estate, and they're the only one that's specific to real estate, but also really focus on results and outcomes and performance.
That's interesting to me because
if I could just add one thing, Stuart, and that is a few years ago, I attended a PRI conference and they had a presentation on some research on trust in the financial community. And the short story is the closing line was something on the order of signals of responsibility are very important in industries that require trust. And when you've got a client that's providing you with $50 million or $100 million or more, trust is a huge factor. So what are those signals of responsibility? They're the metrics that you can provide in E, S, and G. Those certainly are three areas where those metrics to provide those signals of responsibility become incredibly important. And I think really worth noting why the industry, both from the investor side and from the investment manager side, are paying so much attention to it.
Right. It just strikes me as interesting that because we all know each other, at least initially, through the Energy Star program, which for buildings is about building performance, that we've seen a generation of programs, whether it's LEED and now GRES, that were about policy as well as practice, but continue to evolve and be about practice and be about performance. So the programs in my mind, like LEED, like GRES, but like Living Building Challenge and others, are both roadmaps and have been roadmaps and guides, how-to guides, but are also increasingly through this, for instance, this transition in GRES, about, well, not what are you thinking about, but what you actually do.
I think you're 100% right. And it's actually how, when I sit down with clients who are trying to understand, how can I do better? My investors are asking, or I need to do GRES, I don't understand. I really say just what you just said, Stuart, which is GRES and these other are a framework for how you can improve. And they are based on industry best practices, things that your investors are going to be interested in and asking about. But they also can provide better outcomes for residents, tenants, guests, employees, suppliers, investors, right? So, and when I say better outcomes, not just better environmental outcomes or social outcomes or even governance outcomes, but better financial outcomes, better risk-adjusted returns. And I think that's why you're seeing this huge focus on this. And to, as we've touched on, when they've done analysis of firms that have high sustainability or ESG programs, they generally have better risk-adjusted returns. There are exceptions, but funds, overall investment stocks, I mean, they've shown this consistently, and that's why you're just seeing more and more movement in this way.
Okay. I want to go to a question that one of our attendees asked, but before I ask the question, repeat that question, I want to encourage other attendees to ask a question through the chat box. By all means, please go right ahead. We've got a lot of students on the call and several people else I know from the industry. Genevieve Walker wants to know regarding a program, an ESG reporting standard being promulgated by an organization called the Value Reporting Foundation, which is not something I've heard of, by the way. Do you think that that foundation has the ability to get approval for the largest companies across the globe to follow their new standard? And I think that this goes to the broader question of how busy is this marketplace? How many different standards are there out there? And how does one standard rise to the top?
Interesting question. That's an organization that I'm not familiar with. And maybe it's a more broadly based investor organization. Brenna, any familiarity?
Yeah, and I hadn't heard it, so I Googled it.
You
Great
were fast.
question. But it's actually, they said Value Reporting Foundation is to merge SASB, the Sustainable Accounting Standards Board, and IIRC into a credible international organization that maintains the integrated reporting framework, advocates integrated thinking, and sets sustainability disclosure standards for enterprise value creation. So my answer to that question is absolutely. You're going to get more buy-in, because this is another thing, coming back to Larry Fink, but you could do this across all major investors, have really tied reporting and disclosure around SASB and TCFD. And TCFD is the Task Force on Climate-Related Financial Disclosures. So it would make sense, and we've already seen SASB and the Global Reporting Initiative have been trying to align their standards and make sure there's consistency. TCFD and SASB have been trying to align more. So you're going to see this alignment so that hopefully companies can pick one standard and not, have 40 standards to try to respond to. And so I think this is a good sign. I think SASB likely wins out, and not just in the US, but more broadly because of these integrations. But TCFD, I think, is going to be a requirement as well. And TCFD obviously focused specifically on climate, where SASB is broader than just climate issues.
Mhm.
So great question.
Yeah.
And if I just add to that, GRES is aligned with SASB, TCFD,
Yes,
and
good
many of the
point.
other reporting frameworks. So there is globally some integration across all platforms.
Does GRES have any competition?
You
With
go first.
Yeah, I was going to say there are other indices out there. The Dow Jones Sustainability Index, Moody's, Sustainalytics, many others have got reporting indices regarding ESG, but GRES seems to be the only one that's genuinely focused on just real estate.
Gotcha.
Yeah, I would echo that. I mean, not in a meaningful way. Do they have a competition? One, because they're just for real estate and they've been very focused on real estate only. And it is, I use this term, Stuart's heard it before, but we're all our own special snowflake, and real estate is a special snowflake. In there's just different things that come into play that don't in other types of organization. GRES also deals with both public and private real estate in a way that a lot of the others don't really do well, because they don't have access to the information. And so I think they've got a unique niche. Is there opportunity to have alternatives? Absolutely. And I think one thing that does come up for the clients that I work with is the juice worth the squeeze? Right? All the work that we spend on reporting and disclosing and responding to, these requirements for greater transparency. At some point, there's a break-off where am I really could I be spending that time and energy and money that I spend to report to CDP and GRI, or excuse me, and UNPRI and GRES and TCF, right? Could I narrow it, pick one or two horses, and then take that time and money and invest it in efficiency and carbon reductions, and right, like that starts to be a question. And so I always say to my clients, let's be thoughtful. You're going to get a lot of inquiry about responding to different reporting frameworks. You don't need 30. You need to pick one or two that makes sense for you. So for example, use GRES for your benchmarking purposes, and then use SASB and TCFD align for your financial reporting, so that you meet industry standards and are a leader, but you're not trying to report to 50 different frameworks. I don't know. Those are my thoughts.
Yeah, I would add to that there definitely is a cost to reporting. And so you do want to be thoughtful about which funds you report, how you report them, how you use that information. I would argue that GRES is not the end all. It doesn't mean that one fund that scores a 87 is really that much better than a fund that scores an 86. It may depend a little bit on the composition of the fund, but it serves a good tool for external investors, but it also serves as a tool internally to identify those areas of opportunity to consider, how do I improve the performance of our funds.
Okay. Well, we're running toward the end of the hour, and I do have another question that I wanted to float your way, particularly because so many of the people in the audience today are students. Some of them are looking for jobs right away. Some of them are building their career path and looking for jobs in the future. What does it take to get hired by firms such as yours to support your work in this ESG arena? What should our students be studying? What programs should they be becoming familiar with? What makes them attractive to you?
I think Dave should start for sure.
Sure. All skills are needed. But again, I go back to the notion that the firms that can best integrate ESG into their business processes are the firms that will most likely succeed and add more value. That having been said, if you're going into valuations, have a general understanding of building certifications and efficient building systems and how they impact the value. If you're going into accounting, you may want to think a little bit more about how you account for different initiatives and how you value them in terms of, I guess at the end of the day, the value of the property. So if you're investing in a new chiller, it isn't just, what's the payback of the chiller, but, are we avoiding obsolescence? Can we improve the efficiency of the chiller to a point where maybe we can reduce some other equipment, and think more thoughtfully and holistically about the process of managing real estate. So for me, it doesn't matter what area of interest you've got in real estate. Having some knowledge on ESG will add value to any given organization. And today, I think that's an expectation for most folks in HR.
Right.
I would only add that know your audience. So if you're going to interview at LaSalle Investment Management, do some research on them. Understand not only what they are as an organization, how many billions they manage and those kinds of things, but understand what they're doing in sustainability, understand what their commitments are. Try to at least show that you really understand who the organization is. And if you have an interest in that organization, express how and where you think you can contribute. I think nothing bodes better than enthusiasm, showing true interest, and even cursory understanding. You don't have to be an expert, just cursory understanding, which, Google, thankfully there's a thing that can help you with that, will go a long way.
Right. Any shout outs to any of the government or industry association programs that you've been involved with? And if a student came to you and said, hey, I want to get a deeper understanding of an engagement and meet more people in sustainability and ESG and real estate, where do I go in terms of industry groups?
Well, I'll start. I just think ULI and the Green Print is really just quite phenomenal. And you will meet the full spectrum of real estate professionals or people aligned. They're also very welcoming. I'm a big fan of BOMA, not just for sustainability per se, but it's a great network. And once you're, in that network, really people do try to help you. So if you're looking for a job or referral or a connection or want to ask a question or need a mentor, these types of associations in particular, I think are terrific.
Right. And I would add to that, GRES certainly has a number of resources on their webpage. The PRI has a phenomenal set of resources. And then there are other European and Asian organizations like INREV or ANREV. And INREV and ANREV both have a sustainability due diligence questionnaire for investment managers, so that we, in theory, answer those questions once for those European or Asian investors. Frequently, there are other questions that come on board as well, but all of those organizations are working to promote best practices across the ESG spectrum. And of course, there are others, World Green Building Council and many others.
Right. Okay, great. Well, listen, it's been an hour and I really appreciate your time, Brenna Walraven of Corporate Sustainability Strategies and Dave DeVos of LaSalle Investment Management. Thank you for sharing with our students and with our network your perspective and your insights on ESG. And I wish everyone a great day. Thanks again, everyone.
Thanks, everybody. Great time. Thank you so much.
Thanks. Enjoyed it.
Good luck.